Hey guys, welcome to the stock portion of my video. And yeah, this is another video by Fully Informed Trade. My name is Alex Cho, and today I'm just going to go ahead and review the stocks. And yeah, let's go ahead and get into all the market side action. First off, the dollar index has rallied substantially, and the Euro-US dollar did have a substantial pullback, and that has worked against the Dow Jones Industrial Average. Now, this trend line is very important because up until yesterday, I figured that we could probably find support on this area right here. Well, what happened is that on the monthly chart, and this is a monthly chart, between 2009 and this is a trend line between 2009 all the way into 2011. This is a multi-year trend line, and the significance behind a multi-year trend line is that once it's broken, you can see a multi-year decline. Now, this area has been broken. If we have another negative day on the Dow Jones Industrial Average tomorrow without a relief rally closing into Friday, August the 5th, well, it could just be a really, really awful day for us because, again, that would just mean confirmation to the downside, and we would be testing the 20-day moving average in many years. And again, the 20-day moving average might act as support for a short period of time, and we might consolidate, but that still doesn't change the fact that we've had another negative day, we're still below the trend line, and we haven't been able to recover. Now, let's perhaps say that the markets were just suddenly rally, maybe in the last hour, and then we were able to go right above this line, out of the blue. Perhaps that could be a different story, but for right now, I don't think the possibility of that is even in the books. So for now, let's just say that this market is going to continue to go lower, and if we have another negative day, chances are this market is going to break below, and it's going to stay below this trend line for quite a while now. And this kind of goes back to what I was saying earlier. The economy doesn't feel that the U.S. government, without the U.S. government spending that $3 trillion over the next couple of years, we are not going to be able to sustain a 1 or 2 or maybe even a 3% GDP growth economy. Just not going to be able to sustain it. And if the market action is implying that, chances are there might be some validity to it. Economists are starting to say their own thing about it. Starting to say that the U.S. economy has never ever had to contract its spending this much in such a long time. It just comes to show the world that even the U.S. government is going through austerity. This is the first time the U.S. government has gone through austerity in a long time. So now people are starting to interpret that the U.S. government is no longer the rising power. It once was. And therefore they're going to start selling off their positions. So right now we're looking at LinkedIn. LinkedIn has broken below its trend line before. And it hasn't been able to really recover back above that trend line. And and myself personally, I don't really like this, this chart setup one bit. But what it all comes down to for me is that, I don't really have enough reference lines except for that one right there. Maybe, perhaps this one. But this one has already been broken. And you know what? Stocks that have really, really high price-to-earnings multiples in an environment where the stock market is selling off are the first to go first. Are the first to go down first. Okay, those are the shoes that drop the fastest. When I went through the financial crisis of 2008 through 2009, it was always the weaker stocks that fell like a brick, stuff like Lehman Brothers, shaky fundamentals like that, Countrywide Financial. I saw Countrywide Financial drop by 20% in a single trading session. And I will tell you what, guys, when you see stocks move like that, when you see a stock drop by 50% in a single trading session, it really makes you reconsider whether or not you should be trading into these high PE ratio stocks whatsoever. Stuff like LinkedIn that's trading at 1,000 PE ratio is absolutely ridiculous. It's not worth the risk. And to be quite frank and honest with you, if this market does pull back and we do get into a double-dip recession, you're going to have a hard time finding jobs. So while you're at it, guys, if you guys are unemployed, you better start moving and hustling right now, because in a couple years' time, it could be 10 times harder than it already is. Okay, as for LinkedIn, LinkedIn could continue its downwards trend substantially. And what I mean substantially, I mean this, when it dropped by 50%, 50%, that was nothing. Okay, this stock could go all the way down to 20 to 10 bucks. I've seen it happen before on these high-flying PE ratio stocks. Once growth dissipates and you see a money contraction effect, and the banks aren't lending money again, the economy isn't growing at all. In fact, it's contracting. When that happens, the first shoes that drop are always the fastest growing stocks, and LinkedIn is one of them. And it has a high PE ratio with high growth. And you know what? You know what investors and portfolio asset managers do in those scenarios? They dump their positions. They don't care. They're not going to risk it. They're not going to risk losing their job, their multi-billion-dollar hedge fund. They're not going to lose their multi-million-a-year income just because they want to insist on being right. The market is usually always right. And in this instance, if this market pulls back even further, LinkedIn will be hit hard. Okay, so I just want to let you guys know that. As for Bank of America, financial stocks are weak, and there's a very good reason why they're weak. Okay, see, this is how the carry trade usually works. You borrow from the Federal Reserve at a low interest rate, and you buy Treasury bonds. Okay, the only issue is that Treasury bonds interest rates have continued to go down because there has been so much demand for the bonds that, quite frankly, in a stagflation-based economy, you can have really, really low interest rates. Just look at Japan. Japan's not growing, but has ridiculously low interest rates, and the saving rate is extremely high. Once people when people start hoarding money, there is no end to it. Okay, and Japan is a very good example of that. When you hoard money, you reduce the amount of speed money has. Okay, you know, the most important thing is that markets need liquidity. People need to be buying. They need to be selling. The economy needs to be growing. People, you know, there needs to be a lot of transacting. Okay, and banks get hit hardest when there's not enough transacting being done. And so, you know, what's wrong with the banks right now? Property markets are continuing to go lower. Property demand hasn't really been there. Another thing is that property prices have gone lower. Okay, so now they have to write off even bigger losses on their loan portfolio. So again, you know, property prices have gone down. Now you have lower interest rates on bonds, so the carry trade is making them earn much less money. With economic contraction in sight, there is a possibility that banks might have even bigger hemorrhaging on their balance sheets. And, you know, I don't want to revisit another set of bailouts, but if it does happen, it might happen, but I don't think it will, at least not for the major banks. I think they have enough assets on hand that they've gotten rid of a lot of their toxic assets. But it doesn't change the fact that their economy can be, you know, the economy can hit these stocks hard, and we could see the possibility of Bank of America coming back to $6, $7, maybe even $5. I did see $2 and something cents on Bank of America in the past, and you know, it's not really showing up on my chart because it was only there for a day or something. But I don't think it's going to be to that extent. I don't think stocks, you know, the Bank of America stock will be hurt that hard, but it could go down to $5. You know, there's a possibility of that, so I wouldn't really be involved in financial stocks right now. Better to be on the sidelines than to play it risky. Okay, moving on, Deckers Outdoors. Okay, Deckers Outdoors has been a huge name in the industry for quite a while. Everybody loves those UGG boots. Deckers has been growing at a ridiculous rate. But now you're starting to see, you know, the slow stochastics, the percent K breaking below the percent D. There's some convergence showing up. Another thing I do want to point out is that the biggest high-flying stocks, the fastest growing stocks, once there's a damper on that growth, again, guys, once the growth gets dampened a little bit, that's when people start selling off on that company. And once the economy contracts by, let's say, 2-3%, okay, these stocks get hit hard, okay? You wouldn't believe how much damage it does to these type of growth companies and to their stock price, and to their earnings damage and growth and stock price. You know, I remember Apple stock growing and growing and growing its earnings throughout the recession, but Apple stock fell by 50%, okay, throughout the Great Recession, and we could double dip just as easily. We could just double dip just as easily, and that's what I'm saying here is that Deckers Outdoor, not a good idea in this environment, not a good idea. Okay. Moving on, I want to talk about the steel companies. Steel has had a really negative, you know, downtrend for quite a while now. Ever since the beginning of 2011 through February, March, it has continued to go lower. And I wouldn't be buying into steel. In fact, if anything, $35 could be a support level, but if you were to short, it would probably go down to 30, and then you would probably cover your positions for a quick bounce or something like that. But again, steel, U.S. Steel Corporation, not a good idea to be buying. There will be great buying opportunities in the future. Perhaps all the way down at 20 bucks is where I'd be interested. But until we get into that range or area, I wouldn't be a buyer of steel. Okay? So steel is a great place to invest. It's a consistent way to earn money. And it is, you know, it's industrial, yes. But, you know, when is the demand of, when has steel ever gotten obsolete? Steel is never going to get obsolete, at least not in the not for quite a while at least. So again, steel could be a great investment, but not now. Maybe at 20 bucks for sure. U.S. steel does look appealing. Okay, let's move on to Apple Incorporated. Apple Incorporated, yes, it's growing really fast. Yes, they performed very well, but we're looking at a downtrend of the chart. And let's also not forget the fact that through, you know, like I mentioned earlier, even when Apple's earnings were growing throughout the Great Recession, Apple's stock fell by 50%. Just think about that for a second before buying into this company. That's all I have to say. At these type of valuations, at $400 per share, Apple is probably the most expensive, most valuable company by market cap on the Dow Jones. No, not really the Dow Jones, but on the S&P 500. So, again, would I be buying into Apple right now? No. Do they have great earnings? Yes. If Apple stock fell by 50%, would I be buying? Absolutely. If it fell down to $200, maybe even $150, I'd be a buyer there because I do believe in the Apple story as long as Steve Jobs stays alive, of course. But yeah, I wouldn't be a buyer of Apple Corporation. Every high-flying stock is always the one that gets hit the hardest in a downturn. All right? Moving on, Pan American Silver. Silver has had a really bad day today. Silver stocks I would avoid like the plague right now, guys. The main reason why I would avoid them like the plague is that if this area is broken below Pan American Silver, you can easily see the stock retrace itself back to multiple levels, maybe even $20 per share. Okay, so again, don't be a buyer into silver stocks. Don't be a sucker. Avoid it. Whenever you have a contraction in the dollar, and all of a sudden the dollar becomes much more valuable and scarce, you will see silver go up. No, not really go up, but go down in value, along with a basket of commodities and stocks combined. Anyway, that does it for me for today. This has been my stock review for today. Of course, there are many more companies to go over, but, you know, I just wanted to go over the main ones that I wanted to go over for today. I do have much more to go over, but again, you know, just for now, that'll be it for today. If you guys are interested in my videos, be sure to go ahead and subscribe to my YouTube channel. I mean, it's free. I'm just here to do it on a volunteer basis. And also, as for the charting software I use, be sure to go ahead and check out a link right below this video. Take care, folks. I hope the best for you guys in the coming future. Don't be panicking. Don't be scared. Just be more ambitious. Work harder. Things will work out for you. All right. See you guys later. Bye.